Are you a beginner looking to invest your hard-earned money but feeling overwhelmed by the options out there? If so, we've got you covered. In this video, we'll discuss the best investments for beginners so you can make informed decisions and grow your wealth confidently, from stocks and index funds to real estate. But before we get started, I have to let you know that the best update is at the end, so stick around until the very end of the video to find out what it is. Without further delay, let's jump into the world of investing. 1. Start with a low-risk investment. Starting with a low-risk investment is a prudent approach for beginners just starting out in the investing world. It is because low-risk investments offer a safer and more reliable option to grow your money, albeit with a lower potential return. The advantage of low-risk investments is that they are easy to understand and have a predictable return. They can provide a stable base for an investment portfolio, especially for those who cannot tolerate high levels of risk. They are also an excellent option for short-term financial goals, such as saving for a vacation or a down payment on a house. 2. 401k or employer retirement plan. This is an excellent investment for beginners because many employers match employee contributions, and the contributions are made before taxes, which can reduce your taxable income. A 401k is a type of retirement plan employers offer to their employees. As a beginner investor, contributing to a 401k or similar employer-sponsored retirement plan can be an excellent investment choice. The money in your 401k account grows tax-free until you withdraw it in retirement, which can help maximize the growth of your retirement savings over time. Indeed, a 401k plan is a great investment option for beginners because it provides an opportunity to save for retirement with the added benefits of employer matching contributions and potential tax savings. 3. Index funds. Index funds are a type of mutual fund or exchange-traded fund (ETF) that tracks a specific market index such as the S&P 500 or the Dow Jones Industrial Average. These indexes comprise a group of stocks representing a particular segment of the overall stock market. Investing in an index fund means buying a small piece of all the stocks in the underlying index. This provides a level of diversification that can help reduce the risk of investing in any single company's stock. For example, if you were to invest in an S&P 500 index fund, your money would be spread across 500 different companies, which might help mitigate the risk of any one company's stock performing poorly. Another benefit of index funds is that they typically have lower fees than actively managed mutual funds. This is because index funds track the performance of the underlying index and do not require active management by a fund manager. This can help reduce costs and increase the potential for higher investment returns over time. 4. Certificates of deposit, CDs. These low-risk investment options typically offer a fixed interest rate for a specific term. Banks or credit unions usually offer CDs, and they work by depositing a set amount of money with the financial institution for a set period. In exchange, the financial institution pays the investor interest on the money deposited. One of the benefits of CDs is that they are generally considered low-risk investments because they are insured by the Federal Deposit Insurance Corporation, FDIC. This means that even if the financial institution fails, the investor's money is protected up to that amount. CDs are a good option for beginners who want a low-risk investment with a guaranteed return. However, investors should be aware of the potential downsides, such as lower returns and penalties for early withdrawal. 5. Individual stocks. Individual stocks are shares of ownership in a particular company bought and sold on a stock exchange. Investing in individual stocks can be a high-risk, high-reward option for beginners, depending on their willingness to research and comfort level with the potential for volatility. The potential rewards of investing in individual stocks can be significant, as some stocks have the potential to provide high returns over time. Also, it is important to diversify your portfolio and not put all your money in one stock. This means investing in a variety of stocks across different sectors, industries, and geographic regions to help spread the risk and reduce the impact of any one company's performance on the overall portfolio. 6. Real estate investment trusts, REITs. These funds allow individuals to invest in real estate without owning physical property. These funds invest in various real estate assets such as apartments, office buildings, shopping centers, and industrial properties. By generating income from rental income, capital appreciation, and interest from mortgages, REITs offer investors the potential for high yields and diversification. Additionally, they are required by law to distribute at least 90% of their taxable income to investors in the form of dividends, making them an attractive option for those seeking regular income. REITs can be publicly traded, making them accessible to individual investors. REITs also offer the potential for high yields and diversification through their investments in various real estate assets. However, they come with risks such as market fluctuations, interest rate changes, tenant defaults, and changes in the real estate market. Whether you're just starting out or looking to expand your investment portfolio, these options offer a range of opportunities for both growth and stability. But remember, investing is a long-term game, so it's important to have a plan and stick to it. Don't be afraid to seek professional guidance and always research before making any investment decisions. And that's it for today, guys. Thanks for watching. See you in the next video.